Corporate finance leases sound boring until you realize they're worth $1.4 trillion globally. That's trillion with a T. Companies love them because they offer flexibility, tax benefits, and lower upfront costs. But not all leases are created equal. So, what's a corporate finance lease? It's when a company gets access to equipment or assets without buying them outright. Think of it like renting something, but with an end game. You leverage it to grow your business. Here's the pain point for most businesses. You want the latest tech or machinery, but don't have $500 just sitting around. Corporate finance leases step in to say, hey, use our money. It's cheaper than waiting years to save up. Step 1. Identify what your business needs. Asset leasing is common in industries like transportation, IT, or manufacturing. For example, a trucking company can lease 100 trucks instead of buying outright, instantly expanding its operations. Step 2. Pick a lease type, operating or capital. Capital leases act more like a loan where you retain ownership at the end. Operating leases let you walk away, but you never own the asset. Each has its merits. Pro tip: operating leases are often better for tech-heavy companies. Tech depreciates faster than a popsicle on a summer day. Why own something outdated in 3 years? Leasing lets you upgrade while sidestepping obsolescence. Now, a capital lease, though, that's great for businesses who actually want the asset long-term. It's like doing a rent-to-own plan on a house. Over time, it makes sense if you know the asset has long value. The tax benefits? Huge. Lease payments count as expenses, lowering taxable income. Imagine telling Uncle Sam, yeah, I actually owe less this year because I'm renting. That's real money saved, especially on large-scale items. But here's a common hiccup: not reading the fine print. Leases can have hidden fees, unfavorable terms, and balloon payments at the end. Bathroom signs say it best: wash your hands. I'll add, also read your lease terms. Another question I get: why not just use a loan? Loans can have stricter qualifications and higher interest rates. Leasing focuses on the value of the asset more than your credit score. Banks care about you. Leasing companies care about the item. Pro tip number 2: negotiate a purchase option at the end of your lease. Even if you don't think you'll need it now, it gives you leverage if you decide later that you love the asset and can't part ways. To sum it up, corporate finance leases are a strategic play. They help you scale with less cash up front. Just know the rules and pick the lease type that works for you. It's not rocket science, but it is chess.